Good morning, everyone. Hello,
Good
good
morning,
morning.
sir. Good morning, sir.
How are you doing today?
Good morning.
Yeah.
Sorry, apologies for joining the class late. I actually spent more than the scheduled time in my other class,
No
so
problem.
that was the reason for the delay. Okay, kindly confirm if you can see my screen.
Yes, sir.
Okay, thank you. Mr. Matthias, do you
Yes,
have a
sir.
question? Because I can see your answer.
It's just a confirmation. I'm seeing your screen.
Okay, okay. Thank you for confirming. Okay, so last week we took a topic on that's on is it adjusted profits? Yes.
Oh,
Okay. So we
adjusted
took
profit.
adjusted profits last week, and then also I did some further work by saying if the question
Adjusted.
has a loss relief question or capital allowance, I took you on how to charge your loss relief brought forward. I spoke about carry forward losses and current year losses, if you can still remember. And then
Okay.
also I spoke about having capital allowance, unrelieved capital allowance, saying that you can relieve up to two-thirds of the accessible profit in the year. I went further by saying the accessible profits, right, for education tax purpose, okay, is different from the one you use for your company's income tax. Of, for instance, a company may have adjusted profits, so that does not mean that they are not going to pay. Uh, that does not mean that they are not going to pay what's it called, education tax. Okay, so you have to pay education tax when you have adjusted profits. Then when it comes to loss, the loss may be arrived at maybe sorry, where a company have adjusted profits and they are not going to be paying company income tax because the loss brought forward from the prior years have absorbed the whole of the profits they have in the current year. Take for instance, the current year profit is say 50,000 naira. Can you see my writing? Then the brought forward loss. So this is the adjusted for the current year. Then the brought forward loss is say 60,000 naira. Okay. So it means this has absorbed the whole of the profit for the year. Abi? So there'll be a balance of 10,000 naira, which is the loss that will be carried forward to the following year of assessment. And also, I explained about the restriction on capital allowance, saying you have to do two-third. And I said, do not be deceived by the fact that the accessible profit that you have, mere looking at it, saying it is lower than the carrying amount or that the end, it is lower than the total capital allowance, and therefore you are going to allow all the what's it called? You are going to allow sorry, the total capital allowance that you have is lower than the accessible profit, and because of that, you want to allow all the total capital allowance for the year. You may be wrong. Say for instance, the total capital allowance, the total accessible profit you have is say maybe 1,000 naira, and the total capital allowance is 800 naira. Me looking at this, you may want to say 1,800. It can absorb the all the 800 now, right? Because 1,000 is more than 800. But if you are doing this, you are wrong. Okay, because what is required of you is to say the lower of two-third of the accessible profit and the total capital allowance. So if my total capital allowance is 800, what is my two-third of accessible profit? So two-thirds of 1,000 naira will be how much?
Of 1,000 naira is 6667.
So that's 666.67. So which one is
Yes,
lower now? The two-thirds is lower, right? So
yes,
you
sir.
can see that if you are taking 800 as a capital allowance, you are what? You are wrong. When the FRS come for their tax audit, they what? They will disallow this and allow this. So it means what you what you think you've enjoyed before, you now have to pay for it. So the best practice is to take this 66.67, except where the company is a manufacturing company, except when the company is what is a manufacturing company, or the company is what's it called? Um, agric. The company is into agricultural business, agricultural business. So it is only on this two occasion that you can what that you can what's it called? You can allow the total capital allowance, or probably enjoy the all the accessible profit as the capital allowance. So in the case where the capital allowance is 1.2 and your accessible profit is 1,000, so you can enjoy 1,000 as the capital allowance and you carry the remaining 200 forward. Only if you are a manufacturing company or agricultural business. Do you understand that? Is it understood?
Yes, sir.
Hello.
Yes.
Yes, sir.
yes.
Okay. So, any question from our last class before we go into the topic of today? Also, have we able to access the members area?
I have a question, sir.
Okay, sir. Okay, ma'am.
Okay, my question is not based on last class because I was not in class last week. I would have asked the question last week. It was a week two question on the members area. Week two, number two question for that week two. I found I was when I was going through the calculation, I was confused a little bit why they use the 20%, 20% as the corporate tax corporate income tax for 2020 year of assessment. That's the last year of assessment. Why the other 2 years they made use of 30%, which is the normal CIT tax rate. So I don't understand why they use 20% for the last year of assessment. That's my question, sir.
So let me open the question from here so that we can speak to the facts. So let me know when you can see my screen.
Yes.
Can I see my screen? Question two, right? So you are talking about,
Yes, sir. Question two.
okay, so the company is into agricultural products or produce, right? And you see, they said a medium-sized company. A medium what? A medium-sized company incorporated in 2015. The company has pioneer status, Abby, from 2015.
Yes, sir.
Then it is expected to expire after 5 years, Abby, which
Yes,
ended
sir.
February 28th, 2019. So they have these net profits, blah, blah, blah. So as the task manager, you are required to what? To do what? To compute. You are required to compute, sorry, yes, compute the adjusted profit for the relevant years, compute the tax liabilities for the relevant assessment years, right? So
Yes, sir.
now, how many years of assessment do you have here?
3 years.
You have you have 3 years of assessment. From when to when?
From 2018 to 2020.
From 20.
2018.
Sorry. Okay. So from 2018 to 2020, right? So now in 2018, do we have the Finance Act of 2019? The Finance Act, do you know about the Finance Act of 2019? Let me start from there.
Okay, yes, I know some part of the Finance Act, but not all. I know the Finance Act for basis period.
Okay. You know the Finance Act for basis period.
Yes.
Now, are you aware that the Finance Act of 2019 categorized companies into three, classify companies into three categories? Are you aware?
Okay. Also,
Okay. So the Finance Act of 2019 classify companies into three categories. They are, we have small companies, we have medium size company, and we have large companies, right? Now, for each of these set of people, there is a threshold for them, right? And the threshold is for you to qualify as a small company, it means your turnover is less than what? Turnover is less than, or let's say turnover is 25 million naira and below. Okay. Then for you to qualify as a medium-sized company, it means your turnover is between 25 million naira and 100 million naira. Okay. Then for you to qualify as large company, it means your turnover is 100 million naira and above. Are we together? Now, for each of this class, for each of this class, they have their own what? They have their own tax rates. They have their own what? They have their own tax rates. And the tax rate for small company is what? Is 0%. The tax rate for medium company is what? Is 20%. And the tax rate for large company is what? Is 30%. Are we together? So now the Finance Act of 2019 became effective on 1st January 2020. Became effective on when? Sorry, became effective on 13th of February, 13th of February 2020. It became effective on 13th of what? 13th of February 2020. But in practice, right? In practice, we have always assumed for year of assessment beginning on 1st of January 2020. Year of assessment beginning on 1st of January 2020, or you say year of assessment beginning or ending, beginning or ending on or after this effective date. Hmm? Beginning or ending on or after 13th February 2020. So it means if your year end is 31st December 2019, right? You are expected to file within 2020 year of assessment. Abi? And 2020 year of assessment start from 1st January 2020 to 31st December 2020. Am I correct?
Yes, sir.
Sir.
So
Yes.
now if you look at this question, 2018 year of assessment, what's the year? The 2018 year of assessment will be the basis period, Abi, will be 1st January, for instance, 2017, Abi, to 31st 12 2017. Am I correct?
Yes.
2019 year of assessment will be 1st January 18 to 31st 12 18. 2020 year of assessment will be 1st January 19, 31st 12 19. So the question you ask yourself is, in which year of assessment does the Finance Act of 2019 become effective? Which year of assessment?
2020.
In
2020.
it became effective in 2020. Okay, so that's why in the question that we have, okay, in the question that we have now, this question, if you look at it, we have just 1 year of assessment. No? So don't get it wrong. We have just 1 year of assessment, and the one year of assessment is 2020. Okay, the 1 year of assessment that we have. I mean, for the purpose of this, to answer this question A, okay, to answer question A, we have 1 year of assessment because this question that we are giving the net profit in February 2019. I mean, year ended February 2019, and the year of assessment for a year ending 2019 will be what? Will be 2020. So now, if that is the case, it means that the Finance Act has become effective during the year of assessment, right? So you apply the provision of the Finance Act. That's number one. Now going to part B of the question, which is where we have to use the rates. We have to compute the tax liabilities for the relevant assessment years. So in computing the tax liability, because they said relevant assessment years, and we are given that the accumulated profit as at February 28, 2018, okay, is 3968. 3968. That's the accumulated profit. So we need to do our, what's it called? Our adjusted profits. So we have 2018 assessment year, we have 2019 assessment year, and we have 2020. So for a company that have Pioneer, in the question, we were told that the company thereafter applied for a Pioneer status and was granted a certificate with a production day of March 2015. Now, if the production day is March 1st, 2015, the next 1 year will be ending February 28, 2016. Am I correct? The next, hello, are we together? The next 2
Yes.
years
Yes, sir.
will be ending February 28, 2017. Am I correct? And the third year will be ending February 28, 2018.
Yes, sir.
Now, our Pioneer status is usually the first instance for 3 years. If there will be extension, there will be an additional 2 years. But you see that there is a note here saying the management of the company did not apply for extension of the pioneer period. The management of the company did not what? Did not apply for extension of the pioneer period. And if they are not applying for the extension of the pioneer period, what's the implication? So the implication is, when is even their year end, right? We need to know when their year end is. So if their year end is 31st of December, okay, note that. So the honor that they enjoyed up to February 28th, 2018, right? Which is what they are giving us here. This is the accumulated profit for the period. Now, we prepare our what? We have to prepare our adjusted profits. So when we prepare our adjusted profits, we then multiply by 10 divided by 12. But the bone of contention here, to answer your question, is we subject them to comment after the what's it called? The expiration of the pioneer period. So if they are preparing up to 31st of December, so that's 2018 now, we will have 1st of March, okay, 18 to 31st December 18. Okay, so that's the first 10 months. Okay, then we have another, what's it called? The next one will be 1st January 9th to 31st December 19th.
So, sorry, let me take you a little back. I didn't
Okay.
understand why you said the year end is 31st December, but in the question they said the year ended February 28th.
No, so earlier I said, so I'm using an assumption just to explain so that it can be clear to everyone. The most
Okay.
easiest and straightforward basis period is 1st of January to the 1st of December. So that one is simple to everyone. Okay.
Okay.
So what I've only established from this question is, say,
Okay, sir.
when there is a pioneer with us, okay, the pioneer period will start from the production day. Okay, which is the day they granted them the pioneer certificate. So I'm saying that in this question, we were told that they didn't apply further. They didn't apply for extension. So meaning that if they are not applying for extension, their pioneer status will end when? We end on the 8th of February 2018. Do you get that?
Yes.
We end on the 8th
Yes,
of
sir.
February 2018. Now, the implication of that is, if we are subjecting them to commencement period, right? In the old task, in the old rule for commencement period. So the implication is, said we'll be having the following year of assessment. Okay, we have 2018. Okay, so for 2018, because this question now, they didn't specifically tell us when they prepare their accounts to, but we can determine that from this that they give us, right? For them to give us profit to 31st and 28th of February 2019. So it means they prepared accounts up to February of every year. We together. So subjecting them to commencement rule for 2018, the year of assessments, okay, will be from 1st of March 2018 to 31st December to 31st December 2018. Then for 2019 assessments, it says the standard says that you start from the date of commencement up to 12 months. You start from the date of commencement up to 12 months. So that will be from 1st March 2018 to 28th February 2019. Put together. Then for 2020, the standard says that the third year, you use the basis period for the second year, right? You use the basis period for the second year. Using the what? Using the prior year basis. Using what? Using the prior year basis. And prior year for 2020 will be when? Will be 2019. When do they prepare the account to? They prepare the account to February. Abi? So we have 2019. Then you count 1 year back. Counting 1 year back, we count back to 1st of March 2018. We together? Hello, are we together?
Yes, sir.
As of 2018, the Finance Act is not yet in place. So the tax rate for all companies in Nigeria is 30%, except for small companies that are within their first 4 years of operation. That's except for small companies that their turnover is 1 million naira and below, right? Less than 1 million naira. So they are only the ones that are exempted to pay 20% in the former tax law, okay, before the amendments. So for this company, 2019 year of assessment, they will still pay at 30%. Abi? But in 2020, the Finance Act, look at the year end year. The year of assessment is 2020. When does the Finance Act of 2019 became effective? 2020 year of assessment. Abi? So, and if you look at the turnover for the company, what's their turnover? Okay, so I think they are silent with what their turnover is. Or do you have anywhere where they put their turnover? I'm
No,
not
they
sure
are
I can see
silent,
that from
but
this.
the question mentions the medium
Okay, yes,
size.
wait. Exactly. The question mentioned that this is a medium-sized company. So that's an expo. It's even much more straightforward than them giving us revenue to determine it. Because apart from having this, the only thing you can and the other thing you can use to determine it is revenue. To say if the revenue is within 25 million and 100 million, right? But if their turnover is 100 million and above, what size of company will you classify such to?
Large company,
Large company. And their tax rate will be what?
30%.
30%. And if their turnover is 25 million naira and below, where do you classify them to?
Small size companies,
What will be the tax rate?
0
Anything multiplied by zero.
is 0.
So that is why they use 20%. I hope that answers your question.
Yes,
And I
very
hope
well.
every other person in this class have also learned from this. Hello.
Yes, sir. Thank you, sir.
Okay. So let's go back to our main topic. Let me know when you can see my phone.
Yes, I can see us.
Okay. So today's question is of foreign how do we call it? Is on specialized taxation. Okay. Is on specialized taxation. So we have air and sea transportation business, we have insurance business, and we have air and sea transportation business, we have agricultural business, we have insurance business, we have what's it called? Um, wait, sorry, I can't remember. Okay, so there are different type of business that are classified as specialized business because their task is not straightforward. Okay, so that's why they are classified under specialized business. Are we together? So uh so the questions here are quite straightforward. Okay, so the question one is asking us explain the unique procedure for assessing non-Nigerian companies in air and sea transportation business to tax in Nigeria. What are the procedure for assessing non-Nigerian companies in the air and sea transportation business in Nigeria? Any idea? Hello, is there any idea?
We are checking.
You are checking.
Yes.
You want to carry expo? So basically, this question is asking us if you are to subject the air and sea transportation business to tax in Nigeria, what makes them or what qualifies them as a specialized business? Why are we not subjecting them to tax the same way we have done for other companies in Nigeria? So let me assist.
No,
Now
can
the
I try?
procedures. Okay, yes, you can try, sir.
All right, sir. I think why we call them specialized business is because their country of well resident, that is this where they are residented, is not in Nigeria, and there is that possibility they may have been taxed in that country. So probably taxing them like those that are already resident in Nigeria might not give them a fair treatment. That is my own thinking, sir.
Okay, you tried, you tried. So, but they need to be assessed to tax in Nigeria based on the income they have earned from Nigeria. Okay. Please, if you are not speaking, can you mute your mic, please? Okay, so based on the income they have earned in Nigeria, they will be assessed to tax. So if you have read about this taxation of specialized business, especially for this air and sea transportation business, it is very interesting. Okay, so because it talks about transporting, you know, let's say for instance, people out of Nigeria. So let's take um, Ethiopia Airlines. Okay, let's take. Please, if you are not speaking, can you mute your mic? Please, please, Mr. James, mute your mic, please. Mr. James, hello, admin, can you please mute Mr. James for us? Um, Zabit and Mike, I can see your hands up. Do you have a question? If yes, so Zabit, can you go for it first? Then Mike. Hello. Hello, can you hear me? Hello, can you hear me?
Yeah, we're getting you. I hearing you, sir.
Yes, yes, yes.
So
We're hearing you.
it's like those guys just kept their hands up. So maybe they don't have question for us. Okay, so let's go back. So like I was saying, so it has to do with them transporting. So uh loading, loading of passengers, loading of what? Of passengers, livestock, okay, livestock, mails, you know, etc. from Nigeria, okay, from Nigeria and departing in another country. So if Ethiopia Airways is it Airways or Airlines? Sorry, I know Sabi okay. So if they load passengers from Nigeria to say Ethiopia, okay, from Nigeria to Ethiopia, the profits, okay, the income that they earn from the passengers that are loaded in Nigeria will be subject to income tax in Nigeria. Are we together? So this is different from when they load passengers, okay, or males or livestock in Ghana, for instance, okay, and they now had a connecting flight. They had a connecting flight in Nigeria, okay, that is different. So if the passengers were loaded in Ghana but have a transload, okay, or a connecting flight in Nigeria, you cannot subject their income to tax in Nigeria because the passengers are not loaded from where? We are not loaded from Nigeria. They were loaded from Ghana. Are we together? It is also different, it's a different case where Ethiopia Airlines load passengers from Addis Ababa, okay, Addis Ababa, and then terminates, terminates in Nigeria. Terminates where? Terminates
Nigeria.
in Nigeria.
Nigeria.
So
Mm.
the passengers are also not loaded from where? They are not loaded from Nigeria. Hello, are we together? The passengers are not what?
Yes, sir.
Are not
Loaded
loaded
in Nigeria.
in Nigeria. So in that case, you cannot also subject the income from passengers that were loaded in Addis Ababa but terminating, their destination is Nigeria. You cannot subject the income to tax. It is only when they are departing from Nigeria. Hmm? And the departure is not as if they had a connecting flight in Nigeria. They are not transload in Nigeria. So they were fully loaded. Like the uh those going for their pilgrim rites. Okay. So let's say maybe they are going to either Jerusalem or they are going to Mecca. Okay. So the airlines load them from where? Load them from Nigeria. They were loaded from Nigeria. So the income, for accruing to that airline company, loading them from Nigeria and then taking them to their destination in Mecca will be subject to income tax in Nigeria. Now, going to the unique procedure. So the unique procedure will then be what? So The unique procedure is, sorry, I'm trying to fit this thing to my screen. Okay, is it
Before
better?
you go for that, sir,
Okay.
before you go for that, let me get this clarification. I'm clear with the explanation. But in a situation whereby they only stop over, because those who are opportune to go to Mecca, go to pilgrimage, will tell us that they stop over in one country before they pick up.
Mm-hmm.
When you stop over, do you pay tax in that land?
Connecting flight. UMP.
That's the connecting flight. So whether
Okay.
whether they stop over, they still use the same flight, or they take them to another flight. Okay,
Yes. Okay.
they are
Okay.
not going to pay there
All right.
because the passengers are not coming from that country. So
Yes. Okay.
you see, in TAS, one of the reasons why I love TAS is the principle, the laws, and the likes. Okay, so in taxation, when it comes to international taxation, there's something we call source principle. There's something we call source principle, and then um, we have destination principle. Is it destination principle? I think so. So there's something we call source principle and the destination principle. So the source principle is where is the income generated from? Okay. So which
All
is
right.
what we are using here in Nigeria. Do you is the income accruing from Nigeria? So this source principle will mainly be applied to both residents and non-resident company. And the same thing for destination principle too. So for non-residents, oh, where have you enjoyed the income from? If the income is accruing to you from Nigeria, oh, you have to pay tax. Do you understand? So then we call it Nigerian income. We call it what? Nigerian income because you earn the income from Nigerians. Then about the destination principle, okay, you are a Nigerian, but you live in UK or you work in UK or your employer, okay, is in Nigeria and then you work somewhere else. Sorry, you reside somewhere else. Okay. So let me even use Nigerians. Nigerians that earn money from abroad, okay, irrespective of where the income is earned from, will be liable to tax on their global income. They'll be liable to tax on what? On their global income.
And
Okay. Because whether they are residents in Nigeria or not, in as much that their this thing, their source of income is known to the tax authority, they will be assessed to tax on their global income. You can't say, oh no, I'm in US, I work in US, I earn my money in US. So why should I be subject to tax in Nigeria? Consideration is only given to the extent of the tax that you have paid in US. So where the tax you have paid in US is more than the Nigerian tax, they let go. Okay, they're not refunding you. They will not refund you the excess. So you can go. But where the tax you have paid in US is less than the Nigerian tax, okay, you'll be asked to pay the difference. Okay, you'll be asked to pay what? To pay the difference between the US tax and the Nigerian tax. So if the US tax is say maybe 30 million naira and the Nigerian tax total, you have to pay 50 million naira. Okay, so they will give you this and ask you to pay the balance of 20 million naira to the Nigerian authority, to the relevant tax authority in Nigeria. Are we together? Okay, so and this is even applicable if there is a double taxation agreement. If there is a double taxation agreement between the country and Nigeria. So when we get to double taxation, we talk more about that. We've not answered the question yet. Explain the unique procedure. Sorry, my screen is running Olympic. So explain the unique procedure for assessing non-Nigerian companies in air and sea transportation business to tax in Nigeria. So what's the unique thing about it? Based on what we have explained so far. One, we have to determine the global income, determine the global income by aggregating aggregating all the income by aggregating all the income of the particular company, all the income of the particular company in the relevant year of assessment, in the relevant year of assessment. Okay. Then two, the next procedure is to determine, because we've said you only charge them to income on what they earn in Nigeria, Abby. So you determine the Nigerian income. You determine the Nigerian income, that is income on goods, passengers, mails, livestock, that are shipped or carried out of Nigeria, that are shipped in terms of, sorry for my, if my pronunciation is not correct though. I'm a typical Yoruba man. So shipped from where? Shipped or carried out of Nigeria. I explained that earlier, right? I said loading of passengers, livestock, mails, okay, etc. from Nigeria. So meaning either they are shipped out by sea, or carried out, Abby, by air. Then the third one will be compute the global, because it will be difficult for you to determine the global and the Nigerian adjusted profit. So the approach is to do something like an allocation basis. Okay, so you compute the global adjusted profit, then you allocate. Compute the global adjusted profits, global adjusted profits gap, by applying the principle of a trading profit adjustment. So just like we did our adjusted profit last week. Okay, adjustments, treating allowable, disallowable items of income and expenses. Don't forget your taxable income and non-taxable income. Then number four, sorry. Number four, you compute the global adjusted profit. Compute the global adjusted profit ratio using this formula. global adjusted profit divided by global income multiplied by 100 divided by 1. Then step 5, step 5, compute the depreciation ratio, compute the depreciation ratio using the formula depreciation expense, depreciation expense charged at the account divided by the global income multiplied by 100 divided by 1. Then step 6, you can now compute the Nigeria income. Compute the Nigerian income. Compute the Nigerian income, or let's say, let's go straight. Okay. Compute the Nigerian adjusted profit, because we can always determine the Nigerian income in as much that we know, uh, in as much that we can interpret when they have loaded or transported passengers, livestock, mail, out of Nigeria. So compute the Nigerian adjusted profits as follows. You say the adjusted global adjusted profit ratio multiplied by the Nigerian income. Multiply by what? Multiply by the Nigerian income. Okay, so that was why I wanted to say let's determine the Nigerian income first. Then the next step will then be compute the Nigerian adjusted profits by multiplying the adjusted profit ratio, and sorry, the global adjusted profit ratio by the Nigerian income. So after doing that, you arrive at the Nigerian adjusted profit. So after arriving at the Nigerian adjusted profit, the next thing is to do what? Is to compute the Nigerian capital allowance, the capital allowance relief attributable to Nigeria using the depreciation ratio. Using the depreciation ratio. So you say your depreciation ratio, multiplied by the Nigerian income. Your depreciation ratio multiplied by the Nigerian income. You can see that it is straightforward. So after getting that, lastly, you then need to do what? You need to determine the Nigerian profit and the Nigerian accessible profit. Okay. So the next thing is to determine the Nigerian total profit. Step 8, determine the total profit. Determine the total profit, right? Determine the total profit. So now we have determined the Nigerian adjusted profits. We can bring in that Nigerian adjusted profit, right? You less capital allowance. That's the one attributable to Nigeria using the depreciation ratio. Okay. So our total profit is arrived at. Then the last step will be to determine the tax payable. Determine the tax payable by applying. Determine the tax payable by applying the applicable tax rate. By applying the applicable tax rate on the total profits. On the total profits in eight above. On the total profit in eight above. Are we together? So these are the steps. Okay, these are the steps. So one thing you need to know here is the Nigerian income. Okay, will guide you on the tax rates to use. Remember, the Finance Act of 2019 classified companies into how many categories? The Finance Act of 2019 classified companies into how many categories?
3.
Three
Into three
categories.
categories. So depending on their turnover, am I correct? So if after computing the Nigerian income, the turnover is less than 25 million, what will be your tax rate?
0%, sir.
0%. If after determining the Nigerian income, your turnover is between 25 million and 100 million naira,
0 to
what will be the
25
tax
million.
rate? What will be the tax rate?
20%.
20.
20.
20%.
And when the turnover is 100 million naira, what will be the tax rate?
30%.
30%. If it is above 100 million naira, what will be the tax rate?
30.
It will still be 30%.
30.
Are we together?
Mm-mm.
Any question?
Mm. Supposed to be
Sorry? Let me give you the range. This is the range.
all right. Okay.
Small company, medium, large. Okay? You have 0
Okay.
to 25 million. Hmm?
All right.
Medium size, you have 25 million, 1 naira, eh? To
Mm-hmm.
999 million, 999,
Mm-hmm.
999.99. You
Okay.
understand? The large company is 100 million
Okay.
and above.
All
Hmm?
right.
Do you understand this now? Because I know that some students are confused. They still use 20% for 100
Mm-hmm.
million.
Mm. Yes.
So this is the range we need to
Okay.
apply. So if it is 25 million naira and 1 kobo, what rate will you use?
1 naira.
If it is 25,
0%.
you use 20%. Abi, because it is more than 25 million, irrespective of the kobo on it. Hmm?
Okay. Okay. Okay.
Yeah. So that's why I write 25 million 1 naira. Any question? So what you need to do now is to get a question on specialized business, particularly on air and sea transportation business, right? Go and get it. Practice it using this procedure. Oh, see now. Thank God. There is even a question there. Question 4. So before you look at the suggested solution, Based on what we have here and based on my explanation, attempt this question form. So let's do a quiz. Income for passengers flown from Madrid to Nigeria. Is it taxable in Nigeria or not?
It's not
No,
taxable in Nigeria.
Hello.
Why is not
It's not.
why is it not taxable?
because of the source principle, let's say it's applicable. It wasn't derived from Nigeria.
Hmm.
It's not taxable in Nigeria.
Okay. Income for passengers flown from Nigeria to Madrid. Is it
Okay, no,
taxable
that
in
one is taxable. Yes,
Nigeria?
It's taxable because it's from Nigeria.
yes.
Because you see flown from Nigeria, Abi. Okay. Income from cargo loaded into aircraft other routes. Income from cargo loaded into aircraft other routes. Is it taxable in Nigeria or not?
It's not.
Why? Maybe the other ones is because they put from Madrid to Nigeria. That's why he said no.
No,
This one now they said
this one,
loaded into aircraft other routes.
I think it's still the same thing because this one is a other route, not from Nigeria, meaning from other countries.
Because it's not put from Nigeria. Okay. Income from cargo freight from Nigeria to Madrid. Is it taxable in Nigeria or not?
The cargo was loaded in
taxable.
Nigeria.
It's
It's
taxable,
taxable.
sir.
It's
Because you see
taxable.
from Nigeria. No, I'm
Yes.
not aware of that though.
So which we are aware
I'm not.
based on your explanation.
By the way, you are correct. So if you
Thank
have
you.
picked this, you are wrong. If you have picked this, you are wrong. So it is just these two that you need. And to answer this, right, this is their global income,
Mm.
correct? So I will say you determine the global adjusted profit, right? So to determine the global adjusted profit, what do you need? You adjust
Salary.
this global income. I mean, this operating profits, this net profit. Abi, you adjust it for the salariable expenses. You add back depreciation. Am I correct?
Yes.
So except if we have additional information on the salary, so we don't have additional information. So you don't salary is okay, right? Use of airport facilities. Use of airport facilities. Is it disallowable or allowable? Is allowable. Abi, because they didn't specify whether it is private use or public use. Abi, accommodation for is it airtime crew or aircraft crew? This one is
I
notice
think it should
allowable.
be for
Okay.
aircraft.
Is MTN crew. So this should be allowable. Abi, hotel bills, is it allowable or not?
No.
Allowable.
It's
No, now
allowable.
it's yes now
No, it's
because
not
the passenger
allowable.
would have paid for it now.
Okay.
It's allowable. General provision,
Okay.
is it
But
allowable or
sir, they
not?
didn't specify now.
Not
Hotel bills for
allowed. It's
They
passengers.
said
allowed.
hotel bills for passengers.
Passengers.
Uh, General provisions, is it allowable or not?
It's
It's
allowable.
allowable.
It's not allowable, it is disallowable.
General is not
It is only specific provision
specific provisions.
that you allow. So you have your answer. Then after getting your global adjusted profit, what's the next thing? You get your what? Your adjusted ratio, global adjusted ratio. Global adjusted profit ratio, Abi, which is the um which is determined by saying the global adjusted profits divided by global income, Abi, multiplied by 100 divided by 1. After that, for your capital allowance. So in some question, like in this question, and they told us in addition to the above, capital allowances were agreed with the relevant tax authority as 175% of depreciation. So it means our capital allowance okay, will be what? Our capital allowance will be what?
175% times 460,000.
Ẹ̀sìn.
805,000.
That's thanking.
805,000.
Oh.
So this is what the Nigerian Tax Authority agreed, okay, as the capital allowance. So in this case, do we still need the capital allowance ratio? Do
No,
we still
sir.
need the depreciation ratio? No, we don't need the depreciation ratio again
And I agree
because
that it's
directly
175.
they have already given us the ratio, isn't it?
Yes.
Yes,
So
sir.
why in some other case we may have to do it where the examiner is not specific. Okay. So and to do that, we take the depreciation, Abby,
Yes.
divided by global income, multiplied by 100 divided by 1. So don't say that because the examiner has given you 175%, you still want to go ahead and do this. Maybe the examiner is sleeping. That how can the tax authority give 175% of the global depreciation? That is none of your own business. So it's just to follow what the examiner has given you. The examiner have made life easy for you. Why should you make it difficult for yourself? Okay. So after having that, the next thing is just to do what? It's just to do your Nigerian adjusted profit, Abby. So you multiply the global adjusted profit ratio by the Nigerian income, isn't it? You have your figure. Then you less capital allowance, right? You have your figure. You arrive at your total profit. Maybe so.
Mm.
So then you apply your tax rate. Abby,
Yes.
let's say 30%. Then your the tax payable, Abby, will be the answer that you arrived at. Am I correct? Okay. So
Yeah.
go and practice this question. After you have practiced it, you can then look at the what's it called? The suggested solution that will be shared with you. You have taken additional. How many minutes have you taken?
10 minutes.
Mhm. So
Thank you so much, sir.
thank you too. Enjoy the rest of your
Thank you,
weekend.
sir.
Thanks so
Thank
much.
you, sir.
Yes.
Thank you so much, sir.
Enjoy your weekend.
Thanks so much.
And you too. Bye everyone.
All right. See you next week, sir.